Hello, everyone. Hey, my name's Jeremy Kronemeyer. Thank you so much for joining us for another weekly wrap-up. I'm Operations Manager with Wickham Financial Group, and I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy, and thanks for our listeners being on the call. We really saw the market really recover from some earlier losses we saw last week. Now, it was a bit shortened because it was a holiday week, but we saw all-time highs on Nvidia. Why? They just had some blockbuster earnings, and I think that really brought the market back towards the end of the week. We saw the S&P 500, the Nasdaq, which is tech-focused, that was up about 1.5%. On the flip side of that, the Russell 2000, that was down just under 1%. But if we go overseas and we look at Japan and look at the Nikkei 225 index, that hit an all-time high that it posted 34 years ago. And that was up nearly 17% so far in 2024. If we look at the S&P 500, which I generally call the market, that's up, 6% so far year to date. Now, we did see all sectors in the positive for the S&P 500, and that was led by a sector that we just haven't seen lead in a while, and that was consumer staples sector. We did see some other late cycle sectors like industrials or energies or materials. They kept pace as well with the advance. We did see crude oil pull back about 2% with some supply concerns, maybe an oversupply. If we look at Treasury yields, they rose on Wednesday after we looked at some minutes from the FOMC, and that's the Federal Reserve, the Federal Open Market Committee, basically making some statements that they still have concerns about lowering rates or cutting too quickly in light of where inflation was. If you recall, 2 weeks ago, we saw a pretty strong CPI report, and that put some fear or concern that the Fed's going to delay cutting rates or cut rates less overall. We'll just have to see how that shakes out. But we did see rates end the week slightly lower after a weaker than expected S&P Global Flash PMI reading, as well as it being a bit more soft for the U.S. If we look at the U.S. manufacturing activity, it was pretty strong. If we go over to 17 months of that, that was the high, was about 51.5. That was above the expansionary levels that to look at for the second straight month. So we're seeing still some strong growth in the U.S. If we look at sales of existing homes, that rose about 3.1%. Just thinking that buyers are taking advantage of some of these lower mortgage rates, or at least lower than where they were. If we look at inventory for existing homes, we saw those sales increase, but it was still half of the 6-month supply. But we did see the median home value jump to about $379,000. We go overseas, we saw China make one of its largest ever reductions in its benchmark mortgage rate. Its 5-year loan prime rate, they dropped about 25 basis points to 3.95. Why? They got a struggling real estate market, so they're trying to prop that up. If we look at Australia, we saw some wage price index rise about 0.9%, but they didn't really see overly concerned. If we looked at and listened to the Reserve Bank of Australia, they made some comments that they feel like they are starting to see some slower wage growth starting to emerge over there. If we look at Canada, their CPI eased a good bit from 3.4% to 2.9% year over year in January. And if we go to Europe and look at Germany, just weak manufacturing sector, they're continuing to struggle to get some consistent growth back in their economy, back in their sectors. If we kind of looked at this week, and what's on the calendar? Well, it's pretty packed with a lot of economic reports. We're really towards the end, if not really out of earnings season for the most part. So it's all going to come down to earnings. Excuse me, not earnings, but economics, at least in some of these reports. So remember, 2 weeks ago, we saw the US CPI number coming really hot, surprisingly hot. Well, on Thursday, we got the core PCE. That's the price index report. And that's one number that the Fed really pays extra attention to. So that could put some concern or affect the perception of what the Fed might do with policy in terms of lowering, or how quick and how fast. The week will wrap up with some ISM manufacturing PMI numbers. We'll end up looking at some U.S. data like trade balances and wholesale inventory figures just to round out the majority of them.
Got it. Well, we always appreciate the information. I did have a couple, kind of a two-part question for you. Now that you were saying earnings season was wrapping up or getting to the end of wrapping up here, what do you see the direction of the market and maybe some of the biggest concerns or challenges?
Well, I wouldn't be surprised if the market kind of drifts sideways and slightly up. Be prepared for any pullback, correction, 3%, 5%, 10%. I think you always have to be prepared for the volatility because we started out the year pretty strong. The S&P is up around 6 and change, finished the year rather strong. Many sectors that didn't participate last year really started rallying towards the end of the year. Last 2 months have continued to follow through a little bit this year, even though tech, the leader of last year, kind of still taking the lead. So again, volatility is probably the name of the game until we get some clarity on inflation and where the Fed or when the Fed is going to go with lowering and how long they're going to keep rates at these levels.
Gotcha. Well, thank you so much, Graham. Appreciate it. And to our viewers, we did want to mention that we do have wrapped up our February classes for retirement planning today. We have our March classes starting next week on next Tuesday, March 5th is our first one. And we also have Saturday classes, the 9th and 16th, starting next week as well. So if you haven't gone to that class before, or you have a friend or neighbor that would want to come, check out our social media pages or our website, or call here the office, and we can get you set up for that. And we look forward to having you in the future. Talk to you soon. Thank you so much.
Take care.